$5,046.
It sounds like a typo, doesn't it? Or, I don't know, a coordinate on a map.
It sounds like science fiction, but I'm looking at the terminal right here. As of January 26, 2026, spot gold has officially breached that $5,000 mark. Specifically, $5,046 per ounce.
It's a historic psychological barrier. Smashed.
Yeah.
Just completely dismantled.
And the speed of it. That's what's really getting me. I mean, I was looking at the charts just earlier this month, 3 weeks ago, and we were, hovering around 4,800.
Right.
And that felt expensive then. I remember thinking, okay, surely we take a breather here, but then practically overnight, a 0.88% jump in a single session. It's like watching a thermometer just burst right out of the tub.
It's vertical. It's a completely vertical move. But here's the mission for today's deep dive. We can stare at the price tag and gasp, which is fun. Don't get me wrong. I love a good chart gap, but it doesn't really help the listener.
No.
We need to strip this down. We aren't just doing a price report.
Right, because the price is just the symptom.
Exactly. We need to investigate who is buying all this metal, why they are panicking into it right now, and answer the question that I know is staring every single person with a portfolio right in the face.
Which is, do I sell?
That's it. With prices at all-time record highs, is this the top? Do you take the win, cash out, and, I don't know, go buy a boat? Or is this just the new floor?
I'll be honest, I'm kicking myself. I'm looking at these numbers thinking about the good old days of 2024 when I thought 2,000 was too expensive. I just sat on my hands.
A lot of people did.
But now that we're here at 5,000, buying feels incredibly risky. But selling feels like you might be making a huge mistake too.
It feels risky because it signals something profound. High gold prices aren't usually a sign of a healthy, happy, kumbaya global market. They're a symptom. It's the check engine light on the global dashboard just flashing bright red.
So let's pop the hood. Prices don't jump $200 in a few weeks by magic. Someone is driving this bus. And looking at the data we've pulled from the sources, it's pretty clear this isn't just, retail investors buying a few coins for their grandkids.
No, absolutely not. Retail is there, sure. People love shiny things when they get expensive. But retail doesn't move the needle like this. We are talking about institutional scale. We are talking about the whales.
The ETF data stood out to me immediately in the report. The inflows into Western ETFs exchange-traded funds just since the start of 2025, 500 tons.
500 tons.
Just to ground that for everyone listening, 500 tons, that's a massive amount of physical mass. That's roughly 1/6 of the entire world's annual gold production.
Is flowing into vaults to back paper shares in a single year.
It's an immense amount of physical liquidity just being sucked out of the market.
It's vacuumed up. And what's fascinating is that the major financial players, they saw the direction coming, even if the velocity took them by surprise. You look at HSBC's notes from last year, they predicted $5,000 for the first half of 2026.
So we're basically right on schedule. Maybe a few months early, but the roadmap was accurate.
We're ahead of schedule.
What?
And then you look at Goldman Sachs.
Yeah, I saw that. They're even more bullish.
They're already modeling $5,400 by December of this year.
5,400. So if Goldman is right, we aren't even at the ceiling yet. We're just passing through the lobby. But this is where the aha moment happened for me reading through these reports. We talk about ETFs, we talk about hedge funds, we talk about Goldman.
Right.
But there is a much bigger player pushing these numbers up. A player that doesn't care about quarterly profits.
The central banks.
The central banks.
Yeah.
The sheer volume of their buying is just wild. In the first 11 months of 2025, central banks bought 297 tons of gold.
And look at November alone.
45 tons in 30 days.
And that pace isn't slowing down. It's accelerating. The estimates we have for 2026 are pointing towards 755 tons of central bank purchases. That is well above the averages we saw pre-2022.
Okay, but I want to push on this because this is the crux of it all. Why? These are the entities that literally control paper money. The Fed, the ECB, the Bank of Japan, they can print dollars, euros, yen. They have the magic wand. Why are they scrambling to trade the paper they control for a rock they have to dig out of the ground?
That is the multi-trillion-dollar question. And the source material puts it very bluntly. It's not about inflation, and it's not really about jewelry. It's about counterparty risk.
Counterparty risk. Okay, that's a bit of a jargon term. Let's unpack that for someone who isn't a bond trader.
Sure. In simple terms, counterparty risk is the risk that the other guy doesn't pay you back, or can't pay you back, or, in the modern world, won't be allowed to pay you back. If you hold a U.S. Treasury bond, your counterparty is the U.S. government. You trust them to pay you. If you hold dollars in a bank account, your counterparty is the bank.
Right. So you're relying on someone else's promise.
Exactly, you hold a promise. But gold is just gold. It is an asset that is not someone else's liability. But to understand why this matters now, why in 2026 this is the dominant theme, you have to go back to 2022.
The geopolitical shock with Russia, the
Yes,
sanctions.
specifically the immobilization of Russia's reserves. When the G7 froze Russia's foreign reserves, it sent a shockwave through every central bank boardroom in the world. It was a massive wake-up call.
Right.
Suddenly, having your national savings in dollars or euros didn't mean it was safe. It meant it was accessible only if you were on good terms with the issuer.
That's a huge psychological shift. It basically turned the dollar from a neutral storage device, like a digital vault, into a political lever.
Precisely. So central bankers, particularly in emerging markets, they looked at that and said, we need an asset that nobody can freeze. Nobody can default on. Nobody can deny us access to via a computer switch.
And that's gold.
That is gold. It's the ultimate sovereign asset. It doesn't require a password. It doesn't require permission.
And we are seeing this play out in real time with specific countries. The deep dive highlighted Poland. I didn't realize Poland was such a massive player in this space. I usually just think of China or India.
Oh, Poland is the poster child for this strategy right now.
Yep.
As of late 2025, Poland holds over 500 tons of gold.
That is a staggering amount for an economy of that size.
It is. But they aren't done. In January 2026, just this month, they approved a plan to buy another 150 tons.
Another 150. Why do they need that much? Are they planning to pave the streets of Warsaw with it?
Well, their stated goal is for gold to make up 30% of their total reserves. They want to rank in the global top 10 of gold holders. And then you look at where Poland is on the map.
Right on the edge.
They are right on the eastern flank of NATO. This isn't just about investment returns. This is about national security. This is economic independence.
So it's basically a war chest.
It's a shield. If a crisis happens, paper money can lose value or get cut off. Gold in a vault in Warsaw. That is buying power that works no matter what the geopolitical map looks like. And it's not just Poland. Emerging markets are leading this charge across the board. The global average for central bank purchases is now hovering around 60 tons every single month.
Wow.
They are diversifying away from fiat currencies. They are voting with their wallets, or rather, their vaults.
Which brings us to the flip side of this coin. If they are running toward gold, they have to be running away from something else. Because historically, when a central bank wants a safe asset, they don't buy gold, they buy government bonds.
U.S. Treasuries.
Yeah, U.S. Treasuries.
That used to be the automatic reflex.
Yeah.
Risk-free return. Right,
Yeah.
That was the mantra. When things get scary, you buy Uncle Sam's debt. But that narrative is fracturing. The source material talks about fiscal strains, particularly regarding U.S. debt.
I saw the phrase debt refinancing risks. That sounds ominous, but also a little abstract. What does that actually mean for the system?
It's a polite economist way of saying the U.S. has a massive amount of debt, and it is getting significantly more expensive to pay the interest on it. When you combine that with things like tariff threats and political instability, the bond market starts to look less like a sanctuary and more like a risk vector.
The source mentioned Japan in this context, right?
Yes, Japan is traditionally the largest holder of U.S. treasuries outside the U.S., but they are facing their own nightmare with rising bond yields at home. So if the largest holder of your debt is having trouble buying more or even has to sell some to prop up their own currency,
That makes the debt look much less attractive to everyone else.
a lot less attractive. So gold isn't just going up because gold is shiny and nice. It's going up because the alternatives, the safe havens like bonds, are losing their safety rating.
Wow.
The Forest calls it a repricing of declining system confidence. That's a heavy phrase, but it sums it up perfectly.
Declining system confidence. That feels like the headline of the decade.
It really does. Gold is acting as a hedge against systemic fragmentation. The global financial system is cracking a little bit, splitting into blocks, and gold is the putty filling those cracks. It works in every block.
That's a great image, even if it is a little unsettling. Okay, before we get too deep into the doom and gloom of the bond market, I know our listeners want to sleep tonight. I want to pivot. Because gold isn't the only metal having a moment.
You're looking at the sibling.
Silver. It's not just gold hitting records. Silver surged to over $108 per ounce. That's up 4%.
It is a significant move. But what's fascinating here, and I think this often gets missed by the mainstream news, is that the driver for silver is fundamentally different than the driver for gold.
How so? I usually think of them moving in tandem. Gold goes up, silver goes up faster. They're usually dancing partners.
They correlate, sure. But gold is monetary. It's geopolitical. It's about fear and reserves. Silver has some of that. But right now, silver is being driven by industry. It's a technology story.
Right, because you don't just put silver in a vault, you use it. It gets consumed.
Use it in everything. The source specifically points to two massive sectors: artificial intelligence and solar energy.
I know solar panels use silver paste. That's been a driver for a while. But AI, how does AI consume silver? Are the robots wearing jewelry?
Not quite. Think about the hardware powering AI. The specialized chips, the massive servers, the endless rows of data centers that are popping up everywhere, they require highly conductive materials to function efficiently and keep heat down.
Okay.
And silver is the single best conductor of electricity on the periodic table. Better than copper, better than gold.
So as the AI boom demands more computing power, it physically demands more silver to make all the connections.
Exactly. We are building a sci-fi future with AI and renewable energy, and silver is a primary component to make that future work. So gold is rising because central banks are worried about the past, debt, and war. Silver is rising because the market is betting on the future.
It's a dual-engine bull market. Fear driving one, innovation driving the other.
That is a pretty good summary, and that creates a very robust floor for prices.
Okay, so we've established the who and the why. We know the whales are buying. We know the central banks are hoarding to de-risk. We know the tech industry needs the metal to build the future. But let's bring this back to the listener. The person sitting there with maybe a few gold coins they bought years ago, or a gold ETF in their retirement account.
The practical application.
Exactly. The article title explicitly asks, should you sell? If I bought gold at $2,000 or even $3,000 and now it's $5,000, that's a massive profit. The temptation to hit the sell button and lock that in must be huge. I mean, my finger is hovering over the button right now.
It is immense. And it's human nature. You see a gain on the screen, you want to make it real. You want to see those dollars in your account so you can spend them.
So what does the expert analysis say? Do we take the money and run?
Well, the advice is nuanced. It's not a simple yes or no. The source breaks down a few legitimate reasons to sell.
Okay, let's hear the sell arguments first. When is it okay to cash out without feeling like I'm missing the boat?
First, rebalancing. This is just boring, responsible portfolio hygiene. If you wanted gold to be, say, 5% of your portfolio, and because of this price explosion, it's now 10 or 15%, you are overexposed.
Right. You didn't intend to have that much bet on one horse.
Exactly. If gold crashes, your whole portfolio takes a bigger hit than you planned. So it might make sense to trim that back just to keep your risk profile where you want it. Sell a little bit, buy some undervalued stocks maybe.
That makes sense.
Second, known liabilities. If you have a debt to pay, or you're retiring and need the cash flow, or you have a tax bill coming up, if you need the liquidity, obviously you sell.
Sure. You can't pay for groceries with a gold bar well. Not easily, anyway.
And the third is managing tax implications.
Mm-hmm.
Sometimes selling for a profit fits your tax strategy for the year. But, and this is a big but, those are all personal financial management reasons. They aren't market timing reasons.
Right. So don't sell just because you think it can't possibly go higher, because we've seen it can.
Precisely. And this leads to the hold argument, which I think is the most compelling part of this deep dive. The expert warns against what they call the wealth preservation trap.
The wealth preservation trap. That sounds counterintuitive. Explain that.
It's the difference between how an individual thinks and how a central bank thinks. We tend to think in terms of accumulation. I bought at X, I sell at Y, made a profit. We score the game in dollars.
Right.
Central banks don't think like that. They're buying for long-term preservation across historical cycles. They don't care about capital gains taxes next April. They don't care about quarterly profits. They are holding for generational stability.
Whereas I might be tempted to sell to buy a new car.
Right. And here is the danger. The source suggests you evaluate your original rationale. Why did you buy the gold in the first place?
Usually people buy it as a hedge. Insurance against chaos.
Exactly.
Yeah.
You bought it as a hedge against uncertainty, against inflation, against geopolitical instability. Now, look at the world today. Is it less uncertain than when you bought it?
Definitely not. If anything, with prices hitting 5,000, it signals more uncertainty. The world is messier.
Bingo. So if you sell now to take a profit, you are selling your insurance policy right at the moment the house is most likely to catch fire.
That puts in perspective. You're cashing out the hedge right when the hedge is actually doing its job.
And you might be leaving yourself exposed to the very risks you are trying to avoid. The source had a great quote about this. It said, Elevated prices reflect a divide between wealth preservation and accumulation. Meaning, are you trying to accumulate more dollars by selling, or are you trying to preserve your purchasing power? If you sell gold for dollars, and then the dollar loses value because of those debt risks we talked about, did you really win?
You end up with more paper, but the paper buys less stuff. That's the inflation nightmare scenario.
That is the risk. The price of gold isn't just going up, the purchasing power of the currency is going down relative to real assets.
So the verdict seems to be, unless you have a specific financial need like buying a house or paying a debt, the logic suggests holding on, sit on your hands, don't get cute with the market.
The logic suggests that the conditions driving the price up, central bank buying, debt fears, safe haven demand, those conditions are not gone. In fact, they seem to be intensifying.
So let's look forward. We're at $5,046. Where do we go from here? Does this train keep rolling?
The outlook from our sources suggests a structural bull cycle that could persist toward $5,400.
That lines up with the Goldman Sachs prediction we mentioned at the top.
It does. And if geopolitical or fiscal risks get worse, it could go higher. The ceiling hasn't really been established yet because we are in uncharted territory. We have never seen these price levels combined with this level of sovereign buying.
For our listeners who want to keep track of this, so they aren't just reacting to headlines or getting FOMO, what should they be watching? What are the key dashboard indicators?
Two main things. First, watch the monthly central bank purchases. Remember that number, 60 tons.
60 tons a month. That's the benchmark.
If that number stays high or goes up, the floor end of the price is solid. It means the big boys are still accumulating. If central banks stop buying, that changes the dynamic instantly. Second, keep an eye on updates from the World Gold Council. They track the reserve compositions.
Right.
Watch if more countries start pulling a poll and publicly announcing big buy programs. That transparency is key. When a country says, we are buying, it's a political statement as much as a financial one.
It's a vote of no confidence in the status quo. It's them saying, we prefer hard assets over your debt. It really is a fascinating shift. It feels like we are watching history happen. This isn't just a trading opportunity, it's an illustration of shifting financial hierarchies. The old rules about what is safe are being rewritten.
They are being rewritten in real time, and gold is the ink.
So as we wrap up this deep dive into the $5,000 gold one and all, what is the one thought you want our listener to walk away with?
I think it comes back to that paradox we touched on. We are conditioned to trust the currency we use every day. We get paid in it, we buy coffee with it, it feels real to us. But take a step back and look at what the architects of that system are doing.
The central bankers.
The central bankers. If the very entities that control the money supply, the people who can literally print as much paper currency as they want, are frantically trading that paper for gold at all-time high prices, what does that tell you about the confidence they have in their own system?
That is a slightly terrifying but very important question to chew on.
It's the ultimate insider trading signal, isn't it?
It certainly feels like it. Watch what they do, not what they say. Well, on that cheerful note, we will leave you to check your portfolios and maybe look up the price of silver again. Thanks for diving deep with us today.
Always a pleasure.